Good morning, everybody, and welcome to the third in this series of IMAP MDA 360 webinars. Today, we're going to be talking about probably one of the fundamental issues that's arisen as a result of the growth of managed accounts, and that is managing conflicts of interest in a managed account environment. We're joined today by Jenny Mulders from JMGRC Advisory and Jesse Vermiglio, partner from Holley Nethercote, and I'll be introducing them shortly. But let me just talk a little about the MDA 360 program. So this week we have discussed insurance, fiduciary duties. And somebody I was speaking to on the phone this morning said, "Oh, I watched that. Cripes, we better think harder about that issue in our business." Today, conflicts of interest. Tomorrow, we'll be stepping back into perhaps a more technical area of the obligations for fee disclosure before giving advice, during the advice process, and then ongoing. And then on Friday, we'll be joined by Mark Watmore from NMG. And we'll take a step back to a more strategic view of managed accounts and their evolving role for advisors in our shifting ground strategic challenges in managed accounts for advisors. Mark and I will be talking about what those strategic issues are and how advisors are addressing them. So that's the webinar series. We're also offering 3 full-day masterclasses on important issues if you are involved in providing MDA services or giving advice on MDA. So in October, a best practice advice using an MDA service, so the specifics around advice for MDAs. In November, a day ahead of our MDA Summit, we'll run a Responsible Manager Masterclass. We've done this a number of times over the past few years. It's always a great day for responsible managers and those who are perhaps planning to become a responsible manager of their licensee. And then in December, we'll have a session on the risk management frameworks for MDAs. Now, those lead up to the MDA Leadership Summit. As many of you will know, the MDA instrument rolls over every 10 years, and this year is that year. So ASIC will be releasing an updated MDA instrument in September, and they've told me that it will go live on the 1st of October. So on the 19th and 20th of November, we'll have a 2-day summit, which will review the implications of the changes, if any, to the MDA instrument, and how advice licensees and MDA providers will be reshaping their services in the light of those and continuing to provide a managed account service. As you can see from this page, the participants in this week's program are leaders in the professional services area for MDAs. Today, for example, Jesse Vermiglio and Jenny Mulders bring a depth of experience in MDAs that's hard to match. And we'll have that level of expertise in the masterclass series with Simon Caritas, Jenny, Sean Pascoe, a partner from Crows, and in the MDA Leadership Summit. This whole MDA 360 program is sponsored by Mason Stevens, and it's now my pleasure to invite Nick Mitchell from Mason Stevens to talk a little about their involvement in the MDA process. Nick, over to you.
Yeah, thanks very much, Toby, and everyone online today. We are very proud to be partnering with IMAP for the webinar series, and what we're trying to do really is, through the whole series, is demystify the finer points of establishing, managing and advising clients now and then ongoing under an MDA service. So Briefly, for those of you who aren't familiar, Mason Stevens' platform has been at the forefront of MDAs for nearly 16 years now. So we are the only wealth platform in Australia with an integrated MDA offering. So we feel pretty comfortable saying we know what it takes to deliver an exceptional managed account experience at the portfolio manager level, right through to the end client. So that experience runs deep. The majority of funds on our platform operate under an MDA, and that really drives how we've developed our service proposition and platform technology, making sure that that works hopefully as seamlessly as possible for our partners and clients. At Mason Stevens, we are investment people first. So we understand what it takes to deliver investment outcomes, hopefully really exceptional ones. So whether that's utilising our live trading desk, assisting with governance, investment committee frameworks, providing IC representation, or if it's delivering analytics and reporting. We've got a suite of services that enables our partners to deliver the best portfolio outcomes for their clients, particularly so in the wholesale and high net worth space. That's enough from me. I'm really looking forward to hearing from Jenny and Jesse today. Of course, reach out if you'd ever like to chat about how we could assist. But for now, I'll hand it back over to our panelists. I'll hand it back to you, Tobe, and yeah, we begin today's session. Thanks a lot.
Great. Thanks very much, Nick, and thank you for your support through this whole program. So before I hand over to Jenny and Jesse, just a brief word about one of the things which we've got coming up in the near future. Alternatives are becoming an increasing part of the way in which MDAs in particular, but discretionary portfolio management generally is operated. We'll be hosting a session as part of Sydney Alternatives Week on the afternoon of the 16th of September on alternatives and discretionary portfolio management. We're looking at infrastructure. We'll be looking at co-invest. We'll be looking at the role of private capital in supporting and enabling innovation in Australia. So I'd encourage you, if alternatives are part of your consideration set, to attend on the afternoon of the 16th. So now it's my, before we go, let me just say that we've had some excellent questions through the first couple of days. So I'd encourage you, as you're listening to today's session, or if you have questions about conflicts, to fire those in for our panelists today. But now it's my pleasure to invite Jenny Mulders, the founder of JMGRC Advisory, to take us away on conflicts of interest. Jenny, over to you.
Thanks, Toby. Thanks for the introduction, and hi everybody online. I'm very pleased to be here today and hope that I can offer you some valuable insights. Jesse and I work together on a number of mutual clients and projects, and then we've also participated in the IMAP regulatory committee for a number of years. So Toby, just moving on to the first slide, please. So as pointing out here is we're going to try and sort of peel back the layers and dig into the detail as they apply to managed accounts. So we're looking at the actual structures, so I'll give you an overview of that. The regulatory framework, so Jesse will help us look into the legislative and the regulatory framework there and what applies to you. Helping you to identify a conflict, I think probably one of the hardest things, and how do you manage those, how to treat them, and then really give you some practical examples from our experience on things that work and maybe some things that don't. Just moving on, please. So that's just where we're concentrating today. As Toby said, this is a series for managed discretionary accounts, so we are focusing in that space, but with the managed accounts in generally there will still be a lot of application. So I think is to understand that even though these requirements flow through to managed discretionary accounts, we'll look at them and we will touch on managed accounts, so SMAs, and how those might apply to you. I think the other focus as well that we aren't going to dive in particular detail, but whether you're advising retail clients or wholesale clients, you still have an obligation for conflicts of interest. And we will sort of touch on that a little bit as we go through, but we are looking and focusing on the retail managed discretionary account provisions. So we're looking at where a licensee holds the MDA authorization to operate an MDA, advisors who are authorised representatives of that license, so how they need to consider their conflicts, how investments decisions can be made, and how clients are providing their discretionary authority. So that's what we're looking at a managed discretionary account basis. We also have that focus on the SMAs, and we recognise the different structures in that instance. So whether you are insourcing or outsourcing, predominantly we see obviously the SMAs using an outsourced responsible entity or a trustee, and where an advice licensee is developing and managing aspects of their SMA, which is badged for them. So we hope it's going to be pretty obvious as we go through what applies, but please put something in the Q&A and we can see if we can answer that at the end of the session. So I'm going to hand over to Jesse for the next few slides. So he's going to talk about the legislative piece.
Thanks, Jenny. Thanks, Toby, and thanks for the invitation back to discuss conflicts of interest. It's probably one of the more difficult areas to wrap your head around, but also I think it has a bit of a bad rap. I think people hear conflicts of interest and they run for the hills. There is a bit of a pejorative connotation attached to it. There shouldn't be. We all have conflicts of interest in our day-to-day workings in business, and not least of which within financial services as well. And really the legislative framework is one to understand what the obligations are and the expectations are by the regulator in terms of management of conflicts of interest. I hope that you can all see a slide on screen. It is a slide 4. It's a somewhat of a picture of a gentleman in a canoe trying to balance while he is trying to stand in two canoes. The analogy is not mine. It is from Commissioner Hayne, which he used as part of his report and his review into misconduct into the sort of banking industry almost or some time ago now, 2018. I think it's an analogy that's apt for conflicts of interest. And really the critical, and it's a really good way of thinking about conflicts of interest insofar as with those two canoes, you might think of them as competing interests or interests of different individuals, and in some instances where they are aligned and they are all heading in the one direction, the person can balance their way down the river and without any issues. But as soon as those conflicts of interest diverge, that's when choices need to be made and problems may well arise. In fact, we might take the analogy a little bit further a little bit shortly when we start to talk about conflicts prioritisation. Maybe if we can sort of move on now to the next slide. It's about what are the different structures. Oftentimes, conflicts of interest arise effectively because people within the financial services industry hold different roles. In fact, they may well hold or have different hats that they're wearing in terms of the provision of their financial services that they provide. So they may well be an advisor, they may be a product provider, they may be involved in portfolio construction, they might be involved in the investment committee, or they might be an investment advisor, or they might have an interest in any of the businesses along the chain in the provision of the financial services where an MDA is involved, or a managed account for that matter. So whether it be relationships, whether it be structures, whether it be duties, whether it be individual conflicts, there is the potential for conflicts of interest to arise throughout the chain. Importantly, when you think about the term conflicts of interests, you need to really start with the interests first. And certainly in the way in which ASIC expects management of conflicts of interest, which we'll come to shortly, identification of interests is really the first step. So who has what interests? Clients might have an interest in ensuring that they get the best advice or good advice. There might also be interest insofar as businesses in terms of obtaining a profit for the services they provide. The important thing where conflicts management comes into play is where those interests essentially diverge. If your interests are aligned by logic, you don't have a conflict. So the two canoes are heading in the same direction. It's really where those interests start to diverge is where the problem lies. And maybe as we move to the next slide, slide 6, the regulatory framework really tries to address where there is that misalignment or that conflict. And then there is the application of a number of different obligations that arise. This is not an exhaustive list of what you see in slide 6. It is, though, probably some of the key obligations that act to manage conflicts of interest. And you can see there the sources of where they're found. Obviously, the Corporations Act is probably one of the main ones, and there are multiple obligations that are found within the Corporations Act as they relate to conflicts management, not least of which is probably the foundational one, 912A1AA, the obligation to have adequate management of conflicts of interest. That obligation actually supplements probably the foundational obligation of the efficiently, honestly and fair obligation that you can see there. But equally, there are additional obligations that can be found within the Corporations Act. If you're an advisor, you've got a best interest duty obligation, and you've also got a conflicts prioritisation rule there in 961B and 961J, so in the advice side of things. But again, best interest duty and also conflicts prioritisation comes into play if you're an MDA provider as well through the legislative instrument, in which the MDA contract must impose an obligation for the MDA provider to act in the best interest of their client and also to prioritise the interests of clients should there be a conflict. So these are but some of the obligations which go to the management of conflicts of interest. One that's missing there, I would probably add, is also about risk management, the obligation to have adequate risk management arrangements in place as the general obligations. Under the AFSL conditions, those you'll see there that the general condition of ensuring that you have adequate compliance measures in place to ensure compliance with your financial services laws, including conflicts management. If you're in the advisor space, as I said before, you do have a best interest duty obligation, but as we know, the Code of Ethics then imposes additional standards. One of those standards relates to, as we all know, conflicts of interest or the management of those conflicts of interest, standard 3. But again, there are other standards there that also play a role in conflicts management. Then we have certain conflicts of interest which the impact of which is so significant that the legislature has banned them from existing. And conflicted remuneration is one of those. And so if there is a benefit that could reasonably be expected to influence advice or financial service, then the law prohibits conflicted remuneration or prohibits this type of conflict to exist. So when you're thinking about identification, management, one of the ways in which management can occur is through avoidance, and certainly conflicted remuneration is one where avoidance is really the only way in which that can be dealt with. And then finally, as part of the fabric of the regulatory regime, we have ASIC's expectations. Whether it's RG 181, which reflects which I was updated in December of last year, the first time in some 20 years, or its guidance in RG 179 in relation to MDAs, conflicts management and conflicts of interest are pretty key. And obviously, in addition to that, you have your own internal policies and procedures, which then reflect the way in which you'll go ahead and manage conflicts of interest. So that gives you a bit of a mud map of the types of or sources of law and maybe artifacts that you might have that relates to the regulation of conflicts of interest. So the next slide is really a summary and very similar to one I've just covered, slide 7, which side by side has the MDA providers and MDA advisors and the types of obligations that apply to them. There is a level of consistency between the two, but again, I just make the point that for MDA providers, some of these are found within the legislative instrument, the best interest duty, the complex prioritisation rule, and not to misuse information for improper advantage. And the reason why they find themselves within the class order or the legislative instrument is because there is a recognition that MDA providers should reflect very similar complex management obligations that apply to responsible entities and managed investment schemes. So hence the reason why they are applied as part of the MDA contract. Maybe I'll now, again, sort of the next slide, just around some expectations. I'll very quickly just cover off the new RG 181 or the revised RG 181, which has undergone a refresh. It's, in fact, I call it a significant rewrite of the expectations. Now, we still have effectively the key elements of RG 181, which is to identify, assess, and respond to conflicts of interest. Again, and oftentimes in my experience, the identification piece can be quite challenging and difficult because people have an aversion to thinking that they have a conflict of interest. What is probably some of the key differences around the expectations within the current version of RG 181 compared to the previous version is this notion of proportionate and risk-based, that they be tailored to really the seriousness of the harm that the conflict could cause, and is aligned to the nature, scale, and complexity of the business, which is a common theme in terms of compliance arrangements. So proportionate and risk-based is something that the RG goes at length to identify. So it's effectively, how far do you need to go into the management of your conflicts of interest is really based on those concepts. Again, the way in which conflicts can be managed is through either disclosure, control, or avoidance. And probably one of the significant changes is that the expectation that disclosure alone is unlikely to be sufficient. So more than just disclosure, whereas probably in the previous version, there was a heavy reliance on disclosure. The other thing to note, it probably isn't in the slides, is that it does pick up on a lot of the legislative changes that have occurred since the RG was first issued, not least of which is the ban on conflicted remuneration and other obligations that FOFA has introduced. And most importantly, the focus on the consequences of conflicts. And I think really important when going through an analysis of what a conflict of interest, whether you have a conflict of interest and what measures you need to put in place, in understanding what the real consequence of that conflict is should really guide the extent to which the management or the measure is implemented. So the more significant the impact, I would argue, the more heightened the measure should be, or the more or the further the measure should go. And look, and probably the final point I'll make about the distinction between the two regulatory guides is that in the updated regulatory guide, there is a very heavy focus on operational effectiveness and governance. So it is not just sufficient to have documented your compliance, your conflicts of interest compliance measures, but most importantly, that they have been effectively operationalised within your business, and two, that there is a proper governance framework through monitoring and oversight and reporting on conflicts of interest. Okay. probably then moving along. Jenny, we're at slide 10, I think.
Right.
Sorry, I didn't click the unmute button. Yep, sorry. So where we're looking here is where Jesse put a parallel in between the licensee obligations and the advisor's obligations. So as you're, on the advice space, the acting in the client's best interest is a rule that we have been focusing on for a while. And I think, while it took us a while to grapple with, I think everyone's very clear on what that means today. But you also have a priority rule for the licensee. So if you're an MDA operator, you have other obligations in transactions to prioritise your clients over yourself, and for the advisor to prioritise the client's interests. So there are parallels all the way through an MDA relationship that can't be ignored. So I think, is it genuinely in the client's best interest? So some of the things that we look at when in an MDA capacity is if you are asked by AFCA or ASIC, could you identify that the advice is appropriate for the client, that you have assessed the structure and the strategy for the client, and that coming to a decision of an MDA account for this particular client is the right thing to do. Does it tick all the boxes, and does it give the objective outcome for that client? So have you assessed the client's needs and objectives, and does the outcome that's recommended meet those requirements? I think where the MDA adds the complication is when you're looking at that on an advice piece, that's sort of where it stops. But if you're then operating the managed account as well, you then have to look at your client priority, as I said, with transactions. So whether or not it comes to how the other people in the business operate their personal accounts, or whether the business is operating for other clients as well. So how does it focus on one client over another? So putting rules in place for that.
Jenny, I
Yeah.
might just add on that particular slide.
Mm.
Certainly in when, whether it's in AFCA or dealing with ASIC in terms of where the issues of conflicts do arise, what we often see is that the regulator will start with the premise of thinking, well, has something gone wrong here? And if they find that there might be a bit of an issue in the advice territory, let's say, if there is a conflict of interest that hasn't been adequately managed, then what they then start to do is they start to pivot towards not just it being an issue about a particular obligation not being complied with, i.e., the advice, an issue with the advice, or maybe a safe harbour, one of the safe harbour steps, but they'll then quickly move to motivation and whether or not that's been that has resulted from essentially the conflict of interest. So we find that as soon as conflicts of interest do arise, and particularly in where they are not managed, the regulator, and for that matter AFCA as well, do start to move towards the prioritisation rule and start to say, well, has the interests of the client been prioritised? And I sort of made a very quick reference before about the two canoes and maybe bringing back that analogy. And really at the point where that conflict exists, the provider, the financial service provider, the MDA provider, the advisor must make a decision. I need to prioritise one canoe. I need to find myself in just that one canoe, or else alternatively I end up essentially in the river and with other problems. And so just with that analogy in mind, that certainly the prioritisation rule is meant to mediate or control the impact of any potential conflict of interest that does arise.
Thanks, Jesse. Yes, and so I think where that canoe, those two canoes goes, make sure that the client's canoe gets the priority in that boat. Thanks, Toby. So I think so where we want to look at this is in the RG guide. This is what the requirements are. So you must identify your actual or your potential conflicts of interest. Now, this doesn't mean that you ask your compliance manager what your conflicts of interest are. You need to have a robust process for identifying those conflicts of interest. You need to consider it at a board level, at an operational level, and also consider the reasonable man in the street thesis. So what are those conflicts? If you stood on one side of the fence or the other side of the fence, what would be reasonable and considerate in those conflicts? So the and the potential is a hard one to grapple with, and I think where we find licensees having difficulty is actually identifying those conflicts. You're very driven on what you want the business to achieve, what you want to achieve for your clients, and sometimes those conflicts don't raise until you have a reasonable discussion at different levels of management within the firm. So the potential area is the structure today may not give rise to a conflict. You've got your segregation, you've got the right people doing the right job, you've managed various different aspects of the relationship, but then something changes. Somebody's promoted, you change the third-party providers, or you bring something in-house. When those things change, then you do have, you will have a different set of conflicts that you need to consider. So you need to pick apart where those relationships are, who are the people doing things, and actually have a mechanism for going through a process so that in the event that something goes wrong, you can show that you've gone through that governance process, what you've discovered as a conflict, a real conflict or a potential conflict, and how you've dealt with that. So if you don't have the records to demonstrate that at the point that something may go wrong, is you need to be able to demonstrate. And saying, oh yeah, well, we thought about it, the compliance manager, popped it in the register, may not be enough if you need to defend yourself. So it is very important to show that these things are coming out at regular meetings at a reasonably senior and board level management so that you can rely on those. Thanks, Toby. So I think there's a big link in here, and Jessie and I sort of talked about this, how and pretty much everything always comes back to the efficiently, honestly, and fairly. So when you're looking at the whole relationship through to, from the advice that we've talked about, best interest duty, but then when you're actually managing a portfolio of assets for your client, how are you doing that? Are you doing that fairly? Are you being reasonable for the client? Are you looking at your product selection? So how is your research process? How is your analysis? What's the record keeping and the demonstrated assessment that you're making to come to the end of that? So all of those things which are about your efficiently, honestly, and fairly, you have an obligation. So you need to demonstrate all the way through the process, right from where the client comes in and talks to an advisor, through to the actual product and the portfolio being implemented. So there could be a conflict at any part of the process, and every part of that process needs to be fair, reasonable, efficient, and honest. If you have one break in that chain, that can compromise how you're managing, meeting any of your obligations, because if the regulator looks at this and says, hang on, you haven't really addressed your efficiently process here. You've got a clunky process that isn't really addressing your client priority. It's very manual. You're not being reasonable, and you're not being fair to all of your investors or your clients. So that could be an issue for you. So product selection is, with the research, you need to have a level of independence to manage your conflicts. Portfolio construction, who's doing that for you? Are you doing it yourself, or are you outsourcing that to a third party? They both have different conflicts and different management structures and strategies. Investment governance. Again, how are you measuring that? What are you doing about the governance around the actual investment process? You're not going to give carte blanche to anyone, but you need to be able to make sure that it's smooth and not hindered and overburdened. And then the client outcome. So this is a massive focus for ASIC at the moment, is consumer outcomes. So the simplicity, but also consumer outcomes is a big focus for ASIC. And so that's really where you need to be coming back and looking at, and it's specifically called out in the Reg Guide 181, is looking back and saying, okay, this is what we thought we were going to deliver to our clients. Is that actually what we are delivering? So looking at those outcomes, and are they measurable? Is there anything you wanted to add there, Jesse?
No, I'll just reiterate the point about outcomes and the potential for the conflict of interest to cause disadvantage or harm to clients. And I think when you are working through an analysis of conflicts of interest and how you're going to manage them, having a view on the impact that the conflict of interest could have on clients will go a long way in trying to then assess essentially the credibility of the measure that you put in place.
Thanks, Toby. So what we want to talk about next is, the treatment of a conflict. So you've gone through your process, you've talked at the governance levels, you've talked at your operational levels, you've identified some real, actual and potential conflicts. So what are you going to do about it? So we call this a treatment plan. So, if you had something that is so inherently conflicted, you cannot shift that conflict away, it's strongly recommended to avoid that. So it may be that, you're looking at a related party arrangement, but you cannot manage the structure in order to avoid that conflict. So you need to look at a different structure. So you're avoiding that possibility. Control is probably the strongest that we have available to us, where we're actually trying to kind of move forward in business. So employing independent people who've got experience and can give you that independent oversight, making sure that they have true oversight of the conditions of the operations. Segregation of duties is probably the more manageable in most businesses, so large and small. You can put in place segregation of duties without too much interference or too much friction in the business. So really consider and look at who you've got that you're employed or that you're consulting with that can assist you to segregate. So, compliance framework, you might have, the 3 lines, or you have the maker checker process and things like that, just making sure that, but when people are doing that they really understand what's going on. Independent review process, we have external auditors, but what can you do in the interim? So, larger organizations have assurance controls that you can put in place and other arrangements like that. Formal governance arrangements, so you may have external directors or an external compliance committee or asset managers or asset consultants who come and have a look and help you in that journey. Again, making sure that you're documenting all of these decisions and those controls that you're putting in place. The disclosure, we disclose all over the place. We disclose, over disclose, and we're trying to simplify that in a number of different areas where we can. But where you are disclosing, in order for that to be robust, is the client or the consumer needs to understand what it is that you're disclosing. So having it in a fine print at the bottom of a 20-page document where they're not really going to see that, is if it's a real conflict or a risk, is those clients need to be able to understand that and consume that information along with all the the benefits. So when the regulator or AFCA look at these things, they say, okay, is there a balance between, you're saying your product is fantastic over here and it's going to achieve everything. Is there a balance as to what could potentially go wrong? So that's where conflicts form part of that, along with the risks and benefits of any advice. The key thing where you have any of these things, so avoiding, controlling, or disclosing, is making sure that you're monitoring that so that you have a process in place that somebody is monitoring it. So that doesn't necessarily need to be a human. It could be a system that's doing exception reporting, so you can look at those sort of things. You might have a third party who, periodically tests certain things, but it's important to make sure that whatever treatment plan you put in place, that those treatment plans are still working. So if somebody leaves the business, okay, how do you plug that hole and make sure that those controls are still happening? And
Jenny, I might just add there, out of certainly as part of the rewrite of RG 181, those expectations around related party arrangements and the due diligence that's gone into assessing that arrangement, given the fact that it is related, that's really where the focus has been on. And certainly I've had many calls with clients around that increased expectation for related party arrangements. So one thing that we've discussed is around benchmarking and making sure that whatever the services that are being outsourced or being provided by a related party arrangement is on similar terms to what would be at an arm's length arrangement. And I know a lot of people are grappling with that at the moment.
yeah, I think we'll dive into that in some of the examples we've got listed up. So probably just kind of thinking about this is just on the next slide is, a possible assessment framework that you might like to think about. So one of the things that we Jessie and I discussed was about, the benefit. So in these relationships and when you're, in business is we're looking for a benefit. So we're looking that the client has a benefit and obviously the business is going to have a benefit as well. So, or we wouldn't be in business doing the things that we're doing. So, again, I sort of come back to the reasonable man in the street philosophy. So people don't come in for a financial advice or a financial service and expect it to be free, but they also expect it to be fair and reasonable. So when you're breaking down and you're going through the governance scenario and getting your team members involved in identifying your conflicts, look at every party that may benefit in that relationship. So as I said, the client and the advisor, so we'll get some advice fee. How are they charging for that? Is it different because it's this type of arrangement versus a different just a product arrangement? Which licensees are involved? Have we just got one licensee doing everything? Are you outsourcing to an investment manager or a custodian? So all of those are the licensees, but who's doing what and when? Have you got investment committee members who are also getting a benefit from their relationship in this model? So are they also an advisor or are they also a shareholder? How are we managing those conflicts in the relationship? So looking at that, so the who, and then follow the benefits. Like how much is it? Is it direct? So is it easily identifiable as a dollar flow that goes to a particular party or an entity or a person? Or are there other indirect benefits about, by growing the business, by growing, the amount of FUM or the advice pool or other things? So, some of those benefits are tangible and positive and also benefit the client. So if the client has, a bigger investor expertise, then that is also a benefit to the client. So there's more succession planning. They have more advice expertise, and because the organisation is providing training, so you've got to show that there's a demonstrable need for that. Testing it. So looking that would you make the same recommendation if the licensee advisor and investment manager received no additional benefit? So this is kind of comes down to the benchmarking and looking at your value proposition versus others, and is that a reasonable, and would you make that recommendation? So if there's pricing parity across different products, would you still recommend that product or that service or that structure? And ultimately, and we've talked about this already, is the client receiving value? So is the client happy to pay for that service? Do they see value in that service? And are they getting what they are walking in the door to pay for? Make sure that it's objectively supportable and, and fair, so that if somebody else, so if they took it to their, family member and they looked at it and they explained it, and yeah, that makes sense. So the moral judgment piece, and can that client describe to somebody else what it is, what's the value that they're getting for the service that they're paying for? And always it needs to be appropriate. So I think Jessie and I have kind of come up with some of the, conflicts that we often see, and we're just going to have a bit of a chat about some of these things and some of the things that you can think about when you are putting controls in place. But I think when we're looking at those, the benefits or the conflicts, things that we consider regularly, remuneration is always the key one. So who's getting the most remuneration benefit out of this, and is it reasonable? Motivation, and we've touched on this, is we always need to make sure client priority, but what is actually motivating, the key motivation to making that recommendation to the client, or for investing in a particular product structure, or for using a particular service provider. So the motivation needs to be focused on the client priority, and making sure that it's fair, and that we can clearly show that there's management of that. And alignment, again, talking about the canoes, is that if you are aligned with your client's outcomes, and so those client outcomes achieve, your outcomes as well, and that you would invest your dollar alongside your client's dollar, then you're achieving that same outcome. And genuinely understanding the needs, objectives, and circumstances of the clients.
Yeah, I think that's critical. I think when you talk about alignment, it is alignment with the client's personal circumstances, to be able to then, and as Jenny, you've already mentioned, to be able to then document the fact that whatever the service and the recommendation, that it is consistent with certainly the client's objectives, and that it is solely motivated by the interests of the clients.
I think the main issue that we see here, I see Toby's jumped online. I'm not sure if we're getting a time mark. But where you have that related party, or where people are nervous about the vertical integration model, is with, we're talking about MDAs here. So the client must have personal advice, which kind of helps us in that objective. But Toby's just said he's got a few questions for us, Jessie. So we'll talk to that one.
Sounds like we're being wrapped up there, but
no, we're just good. Okay. You want us to move to the questions, Toby?
Well, let's do that, because there are a couple of excellent questions that have come through, and I think if we speak to those, they sort of speak to some of the specific questions. So it would be useful to cover the case when the MDA licensee isn't the advisor's licensee. So I guess this is the question of, does that sort of independent MDA provider structure, whether it's a Mason Stevens, a Philo Implemented, some of the others, a Rhombus, does that reduce the conflict?
I think it reduces the conflict in some areas, but it doesn't negate them. So in the same way that an advisor recommends a particular product on the APL because they might have a bias towards that product, you still need to manage how that product or that service gets on the APL. So looking into the research and the framework as to why you're using a particular platform over another. And again, it's the Jessie touching on the third party analysis. So is the documentation. So it comes down to there's always going to be a conflict. You're charging a fee, and you've probably, when you're looking at an MDA provider, you normally will only have one. So there wouldn't be many licensees that would have multiple MDAs that they would be recommending. So what is the reason that you pick that one, and is that decision tree documented? Is it robust?
Correct.
And does it,
Yeah.
have you looked at that? So if you, devil's advocate here, but if you picked an MDA provider because they paid their fees faster, then you've probably got a bit of an issue here that you need to manage when you're balancing that up against other things. So, but if you're looking at MDA providers for their expertise and the platform use that they've got, so it's easy for the client, it's easy for the advisors. The advisors and the clients can communicate through that platform and give different outcomes. They've looked objectively at the performance of the portfolio construction that's being offered. So all of those things that go into a normal research analysis.
And I would just add that should be not a set and forget analysis, as Jenny said. So yes, you might do that at the beginning when you're selecting who the MDA provider will be, but periodically you need to retest that in the market and say, is this really still the solution for our clients and our client base? And obviously individual clients, you'll advise them separately, but from a sort of a relationship perspective, from a structure perspective, you really want to be testing that decision on a periodic basis as well.
I've just got, can I just add? So the other side of that is, the conflicts and the risks that are, to the actual MDA provider. So because that could come, because there's a requirement for the personal advice, and at the moment, as we know, the instrument, requires us to make a decision on the advice that's been provided. But is the MDA provider doing enough due diligence on the advisors who are recommending to their platform? Have you looked at what their advice process is? Are you comfortable, and have you documented your testing of their systems and processes and their compliance frameworks to make sure that they're managing their conflicts at their end?
There's a question here about, so the question is, how does ASIC aim to get redress for a conflict of interest issue? So I guess that this question is speaking to if ASIC says, well, we don't like that, what's the sort of, recompense or redress they would typically look for?
They generally point to RG271 and they tell you to go and sort it out yourself, to come up with a methodology of how redress is to happen, or how remediation is to happen in circumstances where they're formed a view that there's been a breach of the law. In this case, I think what you've got to do is link the two. You've got to link the conflict of interest, or an issue with conflicts of interest, and link that to the client detriment, client loss. And if that has occurred, because of a relationship or because of a structure, etc., then I think the regulator may well expect under RG271 for there to be some appropriate methodology to recompense a client for being, for example, maybe recommended to the MDA in circumstances where they shouldn't have in that particular case. So there is a framework. I haven't seen it overly used in any great detail on MDAs for that matter, but I must admit, certainly conflicts of interest has arisen in cases of AFCA and the way in which AFCA looks at it, and certainly they will look at the control framework to understand whether or not the conflict of interest has actually caused any loss or detriment to the client.
There's a couple of questions about wholesale clients. So are conflict of interest obligations or treatment different for wholesale clients? Do advisors who specialize in wholesale clients only have conflict of interest issues?
Yeah, I think, and I'll just jump in for a little bit, but so there's one thing that's really important. So if you are a relevant provider, but you are providing advice to wholesale clients, you need to remember that you're still caught by the code. So the conflicts of interest regime still applies, and that's something that you need to manage and identify. The licensee obligations apply whether or not you are advising wholesale clients or retail clients. They just change in probably in the different levels, but also if you're advising true sophisticated wholesale clients who understand that they actually need to read the disclosure in a contract before they sign it, and they can determine whether or not those are risks for them, and they can make an objective decision themselves. The conflict is still there. How you manage it and deal with that with those particular clients might be slightly different to if you're dealing with an MDA provided to a consumer who's not as financially literate as a wholesale client. But the licensee obligations and the Chapter 7 legislative obligations and the RG still apply, and then your fiduciary duty to your clients.
And Andrew Bradley made that point about fiduciary duty yesterday. I think with a stick with a nail in the end of it.
And I have seen that in the past when, a long time ago when managed accounts were, in their infancy and, more in a stockbroking capacity is how does a stockbroker in the days before we had block trades and all of those things, is how are they managing those conflicts? So they're a bit different. The conflicts that we see today are a bit different, a bit more nuanced, and it's probably more about the relationships that you've got. And a wholesale investor is probably more interested in, okay, well, how are you going to take a cut out of my investment philosophy?
Well, there's one here which is actually sort of grows a little out of that point you're just making, Jenny, which is it's a bit detailed. But how would the conflict of interest framework work, for example, in an environment where dealing in OTC products where the price is set by the licensee and the portfolio is also managed by the licensee, e.g. OTC bonds, as the bond broker usually trading as a principal, and the bond transits via the broker's balance sheet. So that's a bit of tricky.
A tough one to throw at us, Toby, on Wednesday afternoon. I think there's the key thing there would be, if you are constructing a bond portfolio, is that the person who is recommending that to their consumer is not the person constructing the bond portfolio. In the same way that if you were managing a different portfolio and that you had, the checks and balances, that the pricing methodology and all of those sort of things. I mean, we've seen it go bad, and Jesse's probably got a little bit more colour on those sort of things. So we've seen where proprietary pricing has been done poorly in an institutional framework, but that's where somebody is doing something illegal. So if you're acting legally and you're pricing fairly and reasonably, and that the bond portfolio manager is doing their job and they've got compliance around that, checking their pricing structure and the systems and processes, and you have somebody who is adding that as a piece of a MDA portfolio to would be a wholesale client because it's OTC, then that's a way that you would manage it. But if you haven't got segregation, I think you've got some major conflicts there that you would have a lot of friction in there. So if something went wrong, you would have a struggle to satisfy a court that you'd done everything that you could.
Yeah, you got all the risks there. You've certainly got you're distributing, your product issuer, you're the counterparty as well as the distributor of the product. Specifically, as Jenny said, pricing transparency will be an issue, and you would have to be able to demonstrate the transparency of that sort of pricing methodology. But yeah, there's a lot in that particular one. But just to sort of round out the conversation on wholesale, just very quickly, obviously the instrument is retail client specific, so the additional obligations around conflicts in the instrument, in the MDA instrument, is really in the retail side of things. That said, the general obligation in AA really that does apply on both wholesale and retail. And as Jenny's already mentioned, if you are a relevant provider doing both, you're going to be captured in any event by the code on when you are even if you are recommending to wholesale clients.
Yeah. So last question. In the event of an asset review or AFCA action, how would
Yep.
an MDA provider best demonstrate operational conflict of interest policy?
Wow. I can tell you what it's not. It's not just one or two lines in the conflicts of interest which says with soft dollar benefits. It's really having engaged with um, the what are the interests that different stakeholders in the business have. Secondly, documenting those, understanding where they conflict, making sure you're implementing measures that are robust, reasonable, objective, the reasonable person in test, as Jenny has already mentioned. Documenting it all, documenting your decisions and why you are making the choices that you are making, and really those artifacts, the conflicts of interest registers, and which indicate and the depth and the robustness of your controls is really what you're going to arm yourself if you're being faced with that kind of question from a regulator.
I think one thing I just want to add is to remember that not only document the things that you have done, but also remember to document the things that you have considered and decided not to do because the conflict was so bad or the risk was too high. Because that will give you, particularly in that initial period where maybe you're choosing a particular service provider, or whether you're going in-house or not, or from an advisor point of view is, you don't take on a particular client because they're not suitable. Actually documenting what you don't do or decide not to pursue is as important, if not more important, than actually what you do. But meeting minutes, having an overall report that goes to your board of what you've decided to do and why, and being able to sort of articulate that to your clients in a disclosure document.
Yeah. Great. Look, thank you very much, Jesse and Jenny. It's been great to go through in detail the conflict of interest process and the issues that it can give rise to in this, which is a relatively potentially conflict-rich environment. So thank you for attending, those of you who have joined us today. Tomorrow, we'll be looking at another area that's really quite technical, which is fee disclosure. What must you disclose and to whom? And then on Friday, we'll be looking at some of the strategic issues that face advisors in thinking about managed account programs. So Jesse, Jenny, thank you very much for your time today. It's been a pleasure to have you join us, and we'll look forward to seeing all of you tomorrow and later in the week. So thanks, Jesse. Thanks, Jenny.
Thanks, Toby.
Thanks, Toby. Thanks, Jenny.